Hello and welcome to the October Nutmeg Investor Update. I'm Pacome Breton, Head of Portfolio Management. So today I'm going to walk you through how markets performed in September and why, and before touching on how our portfolios are currently positioned. So we'll also share our outlook as we approach year-end and explain a few of the portfolio adjustments under consideration for the coming weeks. So let's kick things off with the latest market developments. One of the most significant events in September was the Federal Reserve's decision to resume interest rate cuts after a pause of more than 9 months. And while this move was widely anticipated, and especially following comments from Fed Chair Jerome Powell at the annual Jackson Hole Symposium in August, overall the confirmation of the rate cut was well received by markets. The Fed's decision was influenced by several factors, but underwhelming US jobs data over the summer provided especially strong support for restarting the cycle of lowering rates. Looking ahead, markets currently expect another 2 rate cuts by the Fed by year-end and possibly 1 or 2 more next year, which would bring the interest rate down to around 3 to 3.5%. And so while the job market remains the Fed's primary focus, it's important to remember that controlling inflation is still part of its mandate. And if inflation were to re-emerge as a concern in the coming weeks, the pace of rate cuts could be at risk, which would likely unsettle markets. And elsewhere, not all the news was positive. In Europe, France faces political uncertainty and high levels of debt, which led to a credit rating downgrade and impacted its bond market. And in the UK, after the Bank of England delivered a rate cut in August, it held rates steady in September, as stubbornly high inflation, particularly in the services sector, remains a challenge. And for the Bank of England to lower rates further, and we'll need to see inflation data come down meaningfully. So what did all this mean for markets? So September was generally a good month for what we call risk assets, meaning equity markets performed well globally. US and emerging market equities led the way. Technology stocks, which make up a significant portion of both US and emerging market indices, were key drivers of this positive performance. European equities also advanced, supported by strengths in industrial, while UK stocks lagged somewhat. Both government and corporate bonds had a positive month. UK government bonds, or the gilts, have faced a tough 2025, especially those due to mature much further into the future. However, they stabilized in September, and corporate bonds benefited from the positive tone in government bonds and a general appetite for risk. US investment-grade spreads remain near record lows, reflecting the modest extra yield investors are demanding for holding corporate debt over government bonds. Another notable development was the stabilization of the US dollar, despite the Fed's rate cuts. The dollar has been under pressure for much of 2025, and its steadiness in September could have important implications for other asset classes, and may be particularly important for emerging markets, as well as overall portfolio performance. Actually, on the subject of portfolios, we have maintained a pro-risk stance since May and June, supported by increased certainty on US tariffs, with uncertainty appearing to recede following the so-called Liberation Day announcement. The positioning reflected mainly in our equity overweight has been beneficial. In September, most of our portfolios delivered positive returns across investment styles and risk levels. Looking ahead, we remain comfortable with this view on risk. We're seeing encouraging signs on the macroeconomic front, especially in the US, where growth remains robust and may even accelerate in the coming months. While market valuations, particularly in the US, are elevated for both equities and credit, valuation alone is a poor predictor of short-term returns, and we believe the upcoming US earnings season is shaping up to be supportive for stocks in general. So although as well September and October have often been challenging in the past, with historically higher average volatility compared to the rest of the year, but we haven't seen this pattern this year, with a positively trending market with limited volatility. And in fact, the investment team overall is more inclined to potentially increase risk further in the coming weeks rather than reduce it. As always, thank you for tuning in. If you have any questions or topics you'd like us to cover in next month's update, please get in touch and see you next time.
As with all investing, your capital is at risk. The value of your portfolio with Nutmeg can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not a reliable indicator of future performance. We do not provide investment advice in this update. Always do your own research.